Very nice to see many familiar faces and good friends, and to be back in Davos this year. It also gives me huge pleasure, actually, to introduce to you, if you hadn't met her before or didn't know her or of her, our new chief economist, Geeta Gopinath. We're delighted that she has joined us, and we're all extremely pleased to work together, and I'm really honored that we are sharing the podium today for you. I'm also very grateful to Klaus Schwab and to the World Economic Forum, who are giving us a chance to present the update to our World Economic Outlook this year. And it will be my privilege to say a few remarks without giving you much by way of numbers, because that is the remit of Geeta and Gian Maria. So, how many of you do cross-country skiing here? No? Oh, thank you. Brilliant. Because I want to run the analogy of cross-country skiing for you. I'm not good at downhill, but cross-country, I'm okay. So what do you like when you're a cross-country skier? You like good visibility. No uncertainty. What else do you like? You like when it's kind of stable, and eventually when it's a little bit downhill. You know, risks down, no hazards along the way. Yeah. Third thing you really like as well when you're a cross-country skier is everybody skiing in the tracks. Okay? Now move that to the global economy for a second. Last October, assume we had started cross-country skiing in October, we downgraded our growth forecast a little bit. Risks were on the rise. We had bad news on the trade front, if not actually materializing, at least for some it was, but certainly threats. Well, I'm afraid that we are going to announce a further downward revision of our forecast. So the cross-country skiing is going to be more laborious. More efforts will be required. And the bottom line is that after 2 years of solid expansion, the world economy is growing more slowly than expected, and risks are rising. But even as the economy continues to move ahead, as I said, it is facing significantly higher risks, some of them actually related to policy. And these risks are increasingly intertwined. Think of how higher tariffs and rising uncertainty over future trade policy fed into lower asset prices and higher market volatility. This in turn contributed to tightening financing conditions, including for advanced economies, which is a major risk factor in a world of high debt burden. Now, does that mean that a global recession is around the corner? No. But the risk of a sharper decline in global growth has certainly increased. Add to this the uncertainty, the geopolitical worries, and disappointing long-term growth prospect, and you have an economic picture with a pretty clear message. And the message is the following for policymakers: address remaining vulnerabilities and be ready if a serious slowdown were to materialize. Now, what does that mean? For most countries, it means harnessing the existing growth momentum, because yes, there is growth, in order to create more policy room to act. And the goal is to make sure that economies are more resilient, they are more inclusive, and they move towards more collaboration. So let me distinguish each of these three. More resilient. In terms of policies, it means reducing high government debt, because that would open space that is needed to fight future downward. But this must be done in a fair and growth-friendly fashion. Monetary policy should be data-dependent, and exchange rates should be allowed to act as shock absorbers. Developing macroprudential tools will further financial sector stability and reduce potential vulnerabilities. This also remains the time for economic reforms in order to lift growth, especially in labour markets and infrastructure investments. That's what I mean by resilient. Inclusive. If we are to deliver on the promise of the digital revolution that will be much talked about, in terms of productivity, in terms of employment, and in terms of long-term growth, then we must make sure that it delivers for all people. And that includes helping workers that are displaced as a result of transformations and automation. It means creating new and better opportunities for women, and in particular for young people. This is the theme that I will address in various forums in the next few days. Resilient, inclusive. My third point is collaboration. Effective international cooperation comes down to fairness, to flexibility, and to a commitment for the common good. And that's where solidarity also means self-interest. I will develop that theme in the next few days as well. So what we need to do, all policymakers, all skiers following the tracks, we need to redouble our effort to resolve the shared problems that we are facing. From fixing the global trade system, yes, the G20 has called for that, and it needs to be delivered upon, to fighting corruption and tax evasion, to addressing the existential threat of climate change. What's in it for the IMF? Well, the IMF needs to be in a strong position in order to help all countries, because history suggests that somewhere over the horizon there will be unexpected developments. The international community must come together to build a brighter future for all. I've called this a new multilateralism. And again, we will be developing that topic in the next few months as it applies to macroeconomic policies in all its dimensions and structural reforms as they need to be applied in many corners of the world. Those were my messages. I'm going to disappear and leave the floor to our most eminent economists, starting with our chief economist, Gita. Floor is yours.
Thank you, Managing Director. So I will flesh out a little more what's in the outlook. While global growth in 2018 remained close to post-crisis highs, the global expansion is weakening and at a rate that is somewhat faster than expected. This update of the World Economic Outlook projects global growth at 3.5% in 2019 and 3.6% in 2020. That is 0.2 and 0.1 percentage point below last October's projections. Now, the downward revisions are modest. However, we believe the risks to more significant downward corrections are rising. While financial markets in advanced economies appear to be decoupled from trade tensions for much of 2018, the two have become intertwined more recently, tightening financial conditions and escalating the risks to global growth. We have revised downwards our forecast for advanced economies slightly, mainly due to downward revisions for the euro area. Within the euro area, the significant revisions are for Germany, where production difficulties in the auto sector and lower external demand will weigh on growth in 2019. and for Italy, where sovereign and financial risks and the interconnections between the two are adding to headwinds to growth. The US expansion continues, but the forecast remains for a deceleration with the unwinding of the fiscal stimulus. Across advanced economies, we foresee growth to slow from 2.3% in 2018 to 2% in 2019 and 1.7% in 2020. This softening growth momentum has provided little lift to inflation. While core inflation is close to target in the US, where growth is above trend, it is significantly below target in both the euro area and Japan. Economic activity in emerging and developing countries is also projected to tick down to 4.5% in 2019, with a rebound to 4.9% in 2020. The projection for 2019 has been lowered from October, mainly because of a large projected contraction in Turkey, amid policy tightening and adjustment to more restrictive external financing conditions. There is also a significant downgrade to growth in Mexico in 2019 and 2020, reflecting lower private investment. The projected rebound in 2020 is due to an expected recovery in Argentina and Turkey. The outlook for emerging markets and developing economies reflects the continued headwinds from weaker capital flows following the higher US policy rates and exchange rate depreciations, even though they have become less extreme. Across emerging economies, some of the pickup in inflation reversed towards the end of 2018. Overall, the cyclical forces that propelled broad-based growth since the second half of 2017 may be weakening somewhat faster than we expected in October. Trade and investment have slowed. Industrial production outside the US has decelerated, and purchasing managers' indices have weakened, flagging softening momentum. While this does not mean we are staring at an imminent major downturn, it is important to take stock of the many rising risks. An escalation of trade tensions and a worsening of financial conditions are two key sources of risk to the outlook. Higher trade uncertainty will further dampen investment and disrupt global supply chains. A more serious tightening of financial conditions is particularly costly given the high levels of public and private sector debt in countries. In other risks, China's growth slowdown could be faster than expected, especially if trade tensions continue, and this can trigger abrupt sell-offs in financial and commodity markets, as was the case in 2015-2016. In Europe, the Brexit cliffhanger continues, and the costly spillover between sovereign and financial risks in Italy remain a threat. In the US, a protracted federal government shutdown poses downside risks. Given this backdrop, policymakers need to act now to reverse headwinds to growth and to prepare for the next downturn. The main policy priority is for countries to resolve cooperatively and quickly their trade disagreements and the resulting policy uncertainty, rather than raising harmful barriers and further destabilizing an already slowing global economy. The call of G20 leaders to reform the World Trade Organization in Buenos Aires must be accomplished. Where fiscal space is low, fiscal policy needs to adjust in a growth-friendly manner to ensure public debt is on a sustainable path while protecting the most vulnerable. Monetary policy in advanced economies should continue to normalize carefully. The major central banks are keenly aware of the slowing momentum and we expect they will calibrate their next steps in line with these developments. Macroprudential tools should be used where financial vulnerabilities are building up. And across all economies, measures to boost potential output growth and enhance inclusiveness are imperatives. Lastly, given that policy space for countries is more limited than in 2008, multilateral cooperation will be even more important in the event of a sharper decline in global growth. And it is essential that multilateral institutions like the International Monetary Fund have adequate resources to deal with the rising risks. Thank you.
Thank you very much, Geeta. Let me turn to some questions in the room. If you could please identify yourself by name and affiliation, then we will try and take as many questions as we can. Let me begin with lady down front. Can you hold on for the microphone?
Thank you very much. I'm Julie from iPhone.com of China. My question to Geeta. What's your expectation on Brexit deal and its impact on the global economy? And what's your suggestion to the leaders of EU and Britain how to break the deadlock of Brexit deal if the second voting is failed? Thank you very much.
A no-deal Brexit is one of the major risks to our forecast. Our forecast incorporate a smooth transition, that a deal is actually made, and that there is a smooth transition to the new setup. But if there is a disruptive exit, or if there is continued uncertainty for many more months, both of those are going to weigh negatively on growth going forward. And I think it is imperative for the leaders to resolve this uncertainty immediately.
We're continuing our coverage here from the World Economic Forum's annual meeting in Davos, and joining us now is the Global Chairman and CEO designate for EY, Carmen DiCibio. Thanks very much for joining us here on cnbc TV 18, and congratulations, you take over in July, I believe.
That's correct. Thank you for everything, and I'm very excited about the role. I've been to Davos many times, but it's my first time, obviously, as a Chairman and CEO elect of EY, and I'm excited for the whole event.
So, you know, EY is all about asking better questions here at Davos. That's your hashtag. But let me ask you about the outlook for 2019. All indicators seem to suggest that it is going to be bleaker than 2018, and there are many triggers pointing towards uncertainty. What would you be most concerned about?
Yeah, we do believe that there are certainly some negative headwinds in terms of the global economy. Many of the economies maybe will slightly not grow as much as they did in 18, but we don't believe 18 was bleak. We thought it was pretty good, and we think the same thing about 19. It'll be maybe a little bit slower. There are a lot of geopolitical events that are slowing some of the economy, but when you really look at GDP growth and a lot of the emerging economies, including India. India, it's over 7% GDP growth. I mean, the largest growth in terms of GDP. That's fabulous. And there's, technology, digital change, transformation. That's going to drive a lot of the global economy. And that's a counterbalance versus some of the geopolitical events that are happening.
Just let's stick with the geopolitical events. Yeah. And one of the sort of downside forecasts to global growth is this prolonged U.S. government shutdown. And if this were to continue, how it would impact the U.S. economy and global growth in general. And of course, Brexit, whether Plan B is going to put into motion or eventually work or not. What would be the significant global risks that you would watch out for?
Yeah, so these are all global events. I mean, in terms of the U.S. shutdown, I don't think it's had much of an impact so far. Surely, if it lasts for 6 months, a year, it will have some impact, but not great. The U.S. economy is still doing very well. U.S. corporates are doing very well. So, there's still a good amount of optimism in terms of what's going on. In terms of Brexit, I do think the whole European situation and what's going to happen and Plan B and what is Plan B, but I truly believe that we're going to come to a resolution that's going to be fine for Brexit. I do not believe we're going to have a hard Brexit. I think at some point, cooler minds are going to, pay off and people are going to do the right thing. The European economies are doing okay. They're doing fine. You know, we're very bullish on the Indian economy. We're bullish on the U.S. economy. We do think China and the trade war with China and in the U.S., that is a factor, but there is progress being made there. I do think that you know, China's 6.5% GDP is going to be a bit strained. I do think that there are signs within China that you know, show some slowing down. So now, whether that's the tariffs that are doing that, or whether truly it's just within the Chinese economy itself, that's a question. I don't know the answer to that, but there are opportunities, and so overall, we would say the overall economy for 19 should be good, maybe not quite as good as 18.
2018 was a great year as far as the IPO market was concerned. It was a big year for M&A as well. Do you see that continuing in 2019? And you talked about this digital disruption and transformation. Will that be the real trigger for both M&A as well as, you know, for what we see happening as far as the market's concerned?
Absolutely. Digital transformation, we certainly think M&A is going to continue. Even early this year, there's already been many deals announced. Last year, a booming M&A time. We see it really in sectors like life sciences, health and life sciences, potentially some industrials as well. You know, those are areas that for sure there will be more transactions. Private equity investments continue in a big way. 18 was a boom year in terms of investments, in particular investments in emerging markets, in particular in India. You know, robust investments, robust M&A, that will continue.